You signed the SBA 7 a note on a Tuesday in a strip mall parking lot, engine still running, because the loan officer emailed the closing docs at 6:47 a.m. and wants them back by noon. One signature line asks for your home address. Another asks for your spouse's. By the time you find the personal guarantee clause, you've already initialed 4 other pages without reading them all the way through. You read this one twice. It says if the unit fails, they don't come for the business first. They come for you, 1 unit. That's the count. Not 5, not a territory, not a development schedule. 1 box on a lease you didn't negotiate, in a franchise system you researched for 6 weeks, and now trust more than you trust your own math. The number on the SBA note is $412,000. That breaks down roughly like this. A franchise fee somewhere between $35,000 and $60,000, depending on which brand's FDD you're actually reading, because franchise fees aren't standardized and every system prices its own door differently. Build out, equipment, signage, working capital to cover the first 90 days before revenue shows up. The SBA guarantees up to 85% of that loan to the bank, not to you. You're guaranteeing 100% of it personally for the next 10 years, whether the unit thrives or the roof leaks or the anchor tenant next door goes dark and takes half your foot traffic with it. Take home in year 1, before you've hired anyone to replace yourself behind the counter. Thin. Royalties run 4% to 8% of gross revenue depending on the brand, paid whether you had a good week or not, off the top line before you've covered a single dollar of your own costs. Add a marketing fund contribution, usually 1% to 2% more, also off gross. Between debt service on the SBA note and royalty obligations, a lot of first-year operators are clearing something in the low 5 figures for themselves. Some months clearing nothing, some months float personal cash into the business to make payroll for the 1 employee they could afford to hire. You knew some of this going in because the FTC franchise rule made sure of it. 14 days. That's the minimum window between the day the franchisor hands you the franchise disclosure document and the day they're legally allowed to take your money or your signature. Not a suggestion, a federal floor. You got your FDD on a Monday, and the earliest they could close with you was 2 Mondays later. You spent those 14 days doing what the rule assumes people do and mostly don't, reading all 23 items, checking the litigation history in item 3, counting how many units closed last year in item 20, cross-referencing the franchisor's financial statements in item 21 against how much debt the parent company is already carrying. But the item you kept coming back to, the one you read 4 times, was item 19. Financial performance representations. It's the only place in the entire document where the franchisor is allowed to tell you what existing units actually make, and most of them choose not to say much at all. In this system, roughly 60% of franchisors nationally include an item 19 at all, per FTC guidance and IFA reporting on disclosure trends, and even when they do, it's usually an average or a median or a range across a subset of units that's self-reported, with a footnote telling you results vary and past performance doesn't guarantee your performance. That's it. That's the only real data point standing between your $412,000 in blind faith in a franchise sales rep who's paid to close you, not protect you. You read the item 19 for this brand and it showed average unit gross revenue of $780,000 with a stated range wide enough to drive a truck through. No net profit figure disclosed at all, because a lot of systems stop at gross and let you do your own math on cost of goods, labor, occupancy, and royalty from there. You did that math on a napkin in the parking lot before you signed. It worked on paper in the scenario where nothing goes wrong. So here's where you actually are. Not an owner in the way you pictured it 3 months ago. Not an investor collecting checks while someone else runs the floor. You're behind the counter yourself most days because payroll for a manager would erase what's left after debt service, and debt service isn't optional. You open, you close, you reconcile the till. The cash that comes in covers the note, covers royalty, covers rent, and what's left over some weeks buys groceries and some weeks doesn't quite. This is not a business yet. A business runs without you standing in it 8 hours a day. What you have is a job with a franchise fee attached to the front of it and a personal guarantee attached to the back of it, and the only way out of that math is up. Not a better month behind this one counter. Another unit. Then another. That's the only lever this level gives you, and it's the one you start pulling next. 4 units now, the 5th one under construction, framing up in a strip mall you drive past twice a week to check on progress you can't actually assess because you're not a contractor. The area development agreement that got you here cost $175,000 up front, on top of the debt you were already carrying from Unit 1, and it obligates you to open a fixed number of locations on a fixed schedule inside a fixed territory whether the market cooperates or not. Take home has moved. Not fast, not clean, but real. Somewhere in the $8,000 to $14,000 a month range hits your personal account now, depending on which units had a good quarter and which one had a walk-in cooler die in July. You stopped working shifts 11 months ago. That's the actual marker, more than the unit count, more than the revenue. The day you hired your first general manager and didn't show up to cover a Tuesday close was the day the business became a business instead of a job wearing a franchise logo. You hired 4 general managers total, 1 per unit, because the ADA didn't just buy you territory. It bought you the mathematical certainty that you cannot personally staff 5 locations, and the franchisor knew that before you signed, which is exactly why the agreement exists in the first place. They don't sell development rights to operators. They sell development rights to people who are about to stop operating. The area development agreement itself is the piece nobody explains clearly before you're in it. It's not a bigger franchise fee, it's a different instrument entirely. It grants you exclusive rights to develop a defined number of units inside a defined geographic territory, usually a county, sometimes a metro radius drawn on a map attached as an exhibit, and in exchange you commit to an opening schedule. Unit 2 by month 18, Unit 3 by month 30. Miss the schedule and the franchisor can claw back the undeveloped territory, sometimes with partial refund of the development fee, often without one, depending on the language in the specific agreement you signed. You read that clause 3 times before you initialed it, the same way you read the personal guarantee 3 times on Unit 1, because by now you've learned that the clause you skim is always the clause that costs you later. What the ADA actually buys you is protection from yourself and from competitors at the same time. Without it, nothing stops the franchisor from selling the unit 15 minutes from yours to somebody else next year, somebody who didn't do the work of proving out the market you're standing in. With it, that territory is yours to fill or lose, and the pressure to fill it on schedule is the thing that turns you from a person who owns one location into a person who has to think in a portfolio, whether you're ready to or not. You are, mostly, not ready to. Nobody trains you for the actual shift this requires. Nobody hands you a manual for what it means to stop asking, "How was the shift?" and start asking, "What did the P&L say?" You used to know physically, in your hands and your feet, whether a Saturday was good. Now you find out on the 15th of the month when 4 separate profit and loss statements land in your inbox and you have to figure out why Unit 3's food cost percentage is 2 points higher than Unit 1's when they're running the same menu, same pricing, same supplier contract. The answer is usually a general manager who's either sloppy with waste or quietly stealing, and you don't know which until you drive out there yourself, which is the last thing the ADA was supposed to require of you, and the thing you still end up doing anyway. More often than you'd like to admit. The economics multiply, but not cleanly. Royalty and marketing fund obligations scale directly with revenue across all 5 units now, so the top-line number leaving your accounts every month is 5 times bigger than it was at Unit 1. But managerial overhead scaled too. 4 general manager salaries, assistant managers at the 2 higher volume units, a part-time bookkeeper because you can no longer track 4 sets of books in a spreadsheet on Sunday nights the way you did with 1. Net margin across the portfolio still sits in a thin band, somewhere between 8% and 14% depending on the unit, the market, and how good each general manager actually is at controlling labor, which is the single biggest lever any of them has, and the one that varies most by who's running the shift you're not running anymore. The first real cash surplus shows up around Unit 4. Not wealth, surplus. The difference between what comes in and what goes out finally has enough room in it that you're not moving money between accounts to cover a payroll date. But the debt hasn't gone anywhere. 4 SBA notes, sometimes structured as one larger note against the development agreement, all still personally guaranteed, all still carrying your home address on the paperwork. 5 units means 5 ways the ceiling can fall on you personally if the portfolio turns, not 1. You didn't reduce your exposure by adding units. You multiplied it and then hoped the math worked in your favor faster than the risk could catch up. What actually changed, underneath the revenue and the leverage and the schedule you're chasing to keep your territory, is the job itself. You don't manage customers anymore. You manage the 4 people who manage the customers, and half of what makes this level work or fail has nothing to do with food cost or foot traffic, and everything to do with whether you hire general managers who can run a shift better than you ever did, or whether you hired the first 4 people who said yes because the opening schedule in your ADA didn't leave you time to be picky. 20 units now, 2 states, 3 counties, a payroll run that used to take you an afternoon and now takes a department. Adding a second brand costs you somewhere between $600,000 and $1.2 million depending on the concept, the territory rights attached to it, and whatever the second franchisor's FDD item 19 says its average unit volume actually is, which you now read the way. Other people read weather reports looking for the storm hidden in the footnotes. Take home has moved again. Somewhere in the $40,000 to $70,000 a month range hits your personal account before you remember that most of it isn't personal anymore. It belongs to an entity you built specifically so it wouldn't have to be. That entity is the actual story at this level, not the 20th unit. The 20th unit is just a location. The entity is a decision. Somewhere around unit 14 or 15, the spreadsheet stopped working. Not because you're bad at spreadsheets. Because 20 general managers, 4 regional supervisors, 6 different landlords, 2 payroll cadences, and 1 franchisor's royalty schedule sitting on top of a second one you're about to add cannot live in a workbook a bookkeeper updates on Sundays anymore. You need actual infrastructure. Payroll systems that run themselves and flag the exceptions instead of you finding them. Supply contracts renegotiated not per unit but across the whole portfolio because the vendor who was charging you retail adjacent pricing at unit 3 will drop 8 to 15 points off cost of goods once you're ordering for 20 locations at once, and that discount is the first real proof that scale is doing something for you that hustle never could. So you form a management company. Not a rebrand, not a new concept, a holding structure sitting above the operating units, and it does one specific thing. It charges each unit a fee for services the unit used to pay for piecemeal. Payroll processing, HR, accounting, supply chain negotiation, marketing coordination across brands. Somewhere between 3% and 6% of each unit's revenue flows up to the management company as a service fee on top of the royalty each unit already owes its franchisor. That's the first layer of corporate structure you've ever built, and it's not cosmetic. It's the difference between 20 businesses that each separately negotiate their own supply contracts and one company that negotiates once and distributes the discount downward. You didn't plan this the way it sounds now, clean and deliberate. You built it because you were drowning in duplicate work, 20 versions of the same HR question, 20 versions of the same vendor call, and an accountant finally said the sentence that changed how you saw the whole thing. You're running 20 businesses that could be run by one. The management company isn't a franchise concept. It's not disclosed under the FTC's 14-day rule the way the operating brands are because it isn't selling franchises to anyone. It's just the thing sitting above the units, charging them for existing. The second brand is where the diversification logic actually gets tested. You don't add it because you're bored of the first one. You add it because 20 units of a single concept means 20 units exposed to the same supplier shock, the same regional downturn, the same franchisor decision you have zero control over, one bad national ad campaign, or one supply chain problem at their level, and all 20 of your units feel it the same week. A second brand, ideally something adjacent enough that it can share real estate and staffing logic but different enough that its revenue doesn't rise and fall with the same triggers, spreads that risk in a way one concept never can, no matter how well you run it. The cross-brand leverage is the part nobody explains until you're doing it. You've got a strip mall lease coming up for renewal on a first brand unit that's underperforming, and instead of renewing it as is, you convert half the square footage to the second brand and run both concepts out of one address. Splitting rent, splitting a manager's oversight, sometimes literally sharing a kitchen build-out depending on what the 2 franchise agreements allow. Staff cross-train across both brands during off-peak shifts instead of sitting idle. You didn't invent this. Multi-unit operators have been doing it for years. But you're doing it now, for the first time, with your own money and your own signature on both leases. Royalty stacking is the number you have to hold in your head every month from here forward. Brand 1 takes its royalty off the top, somewhere in the 5% to 9% range depending on the agreement. Brand 2 takes its own cut, often similar, sometimes different, and both funds require separate marketing contributions on top of that, another 1% to 3% each. Then the management company's service fee comes off before anything reaches you. Layer that across 20 locations and the arithmetic that used to be simple at Unit 1, revenue minus cost of goods minus labor, minus royalty equals your number, now runs through 4 separate deductions before it ever gets close to your account. But margin ranges shift here too, and not always downward. The supply discounts you negotiated at scale start showing up as basis points of margin recovered across every unit simultaneously, sometimes clawing back more than the second brand's royalty cost you in the first place. Net margin at this level typically settles somewhere between 10% and 16% portfolio-wide, wider than it was at 5 units, because scale is finally doing arithmetic in your favor instead of just adding more places for things to go wrong. The IFA's franchising economic outlook has been tracking multi-unit, multi-brand operators as one of the fastest growing segments in the industry for years now. Output and unit counts in the space climbing faster than single-unit franchise growth in most reporting periods, and standing here at 20 units with a management company on top and a second brand underneath it, you understand exactly why. This is where the industry is actually moving. Not toward more first-time single-unit owners, toward people like you aggregating. Because that's the honest word for what happened to you somewhere between Unit 12 and Unit 20. You didn't build a bigger shop. You built a company with departments, an org chart, a service fee flowing upward, and a second brand's royalty flowing sideways into the same reporting structure as the first. Nobody down at Unit 6 knows your name anymore. They know the management companies. That's not a loss. That's the point. 112 units now. 4 brands, 3 states, and a capital problem that has nothing to do with running out of money and everything to do with what kind of money is sitting on your balance sheet. Debt recapitalization at this level runs somewhere between $18 million and $40 million, depending on how many of those units you own the real estate under, and take-home has stopped being a number that lands in your account at all. It's a number your CFO reports to you in a meeting, alongside distributions, alongside a tax bill that requires its own line item. Somewhere in the range of $300,000 to $800,000 a month moves through the structure as owner distribution, but by now you've stopped thinking of it as your money the moment it appears. It's the entity's money first. You're just one of the people it eventually reaches. The sale-leaseback is the move that actually changes what you are. You own the dirt under maybe 30 of your locations by now, bought over years, 1 unit at a time, because SBA 7 of financing back at Unit 1 nudged you toward owning the building whenever the deal allowed it. That real estate has been sitting there quietly, appreciating, doing nothing for you except lowering your monthly occupancy cost. A sale-leaseback changes that. You sell the real estate to a REIT or a real estate fund, 30 properties in one transaction, and immediately you're holding $12 to $25 million in cash you didn't have Tuesday morning. You sign a lease back on every single property. Same day, same buildings, and you keep operating exactly as before, except now the dirt belongs to someone else, and the cash belongs to you. It's not free money. Your occupancy cost as a percentage of revenue ticks up a point or two once the lease payment replaces what used to be a mortgage payment with no landlord attached. But the capital unlocked funds the next acquisition, the next brand, the next recapitalization, and unlike a loan, nobody's calling it due. This is also the point where EBITDA multiples enter every conversation you have about the business, because nobody is buying units anymore. They're buying a portfolio. At 5 units, a buyer prices you off a multiple of a single location's cash flow, maybe 2 to 3 times EBITDA, because the risk of one bad manager wiping out the whole return is real and priced in. At 100 units across 4 brands, the risk profile is different. No single unit failing moves the portfolio number in any meaningful way, and buyers start pricing the whole structure at 6 to 10 times EBITDA, sometimes higher depending on brand mix, real estate ownership, and growth trajectory. That multiple range is the entire reason recapitalization makes sense here. The same dollar of EBITDA is worth 2 to 3 times more attached to a 100-unit platform than it was attached to a 5-unit operation, and that arithmetic alone justifies every hour you spend building the management company nobody at Unit 6 ever noticed. The ceiling proof isn't theoretical. Flynn Group runs close to 2,700 units across Applebee's, Taco Bell, Panera, Wendy's, and Arby's, generating revenue north of $4 billion, and it started the same way you did, as a single-unit operator who kept signing. Sun Holdings operates over 1,200 units across Burger King, Popeyes, Godfather's Pizza, and other brands, built the same way, one acquisition and one recapitalization at a time. And Carrols Restaurant Group, which spent decades as the largest Burger King franchisee in the country running hundreds of units, got acquired outright by Restaurant Brands International in 2024, a franchisee bought by the franchisor itself, the roll-up becoming valuable enough that the parent company wanted to own the aggregator instead of just collecting royalties from it. That's the ceiling, not a bigger single shop, an entity large enough that the brand owner writes a check to absorb it. Level 5 is where a private equity firm shows up, and not as a lender. As a minority partner, somewhere around $500 million in platform value, usually built across 300 to 500 plus units spanning 5 or more brands, institutional capital starts looking at your entity the way it looks at any other infrastructure asset: recurring cash flow, real estate backing it, diversified brand exposure, reducing single concept risk. The firm buys a minority stake, typically 20% to 40%, in exchange for growth capital that lets you acquire faster than organic cash flow ever could. You give up some equity, you keep control of the entity. And the capital funds the next 15 acquisitions instead of the next 3. The platform structure at this point looks nothing like what you started with. It's a holding company sitting above 5, 6, sometimes 8 operating brands, each one a separate legal entity underneath it for liability and franchise agreement reasons, but reporting up through one consolidated set of financials, one management team, one real estate portfolio held in yet another entity that leases space down to every operating unit at market rate. You don't own units anymore. You own the holding company that owns the units and the dirt underneath them, and the distinction matters because it's the only thing anyone will ever actually transact against. That's the image this ends on, and it's the only one that matters. Not the 100th store opening, not the ribbon cutting, not a single unit anywhere in the portfolio. The entity. The holding company that owns 112 operating agreements, 30 real estate leases, 4 franchisor relationships, and 1 private equity partner sitting at 30%. When this ever sells, and it eventually will, it won't sell store by store. It'll sell as one signature on one document, transferring ownership of the entity itself, and every unit, every lease, every royalty obligation moves with it in that single motion. You didn't build a business. You built the thing that owns businesses. That's the whole ladder, top to bottom. One signature at the start, one signature at the end, and everything in between was just capital structure.